Hey everyone, this month I am partnering with Questrade and they are rolling out some very seriously cool tools for investors. I was actually just at their massive product showcase called The Dawn of Investing. And after meeting with the development team, I can tell you, Questrade really is focused on building the future of investing right here in Canada. They've rolled out some real game changers, like they have completely redesigned Questrade Pro, which is now in beta testing. You can trade directly from best-in-class charts with lightning-fast execution, AI tools, and a full trader performance dashboard. The best part is that it's all free. And starting this December, you can actually trade assets like real physical gold right inside your account with Quest Metals, just like a stock. And they're the first in Canada to make cash-secured puts available in all your registered accounts except for an RESP. That's actually pretty huge. Sophisticated income-generating tools now available to everyday Canadian investors. But you know, the one that actually really floored me was their 2026 announcement about custom indexing. You can actually take the S&P 500, dial down the weighting in one sector, dial it up in another, and buy those stocks directly. Why would you pay an ETF fee when you can essentially build your own customizable index for free? Questrade is giving you the control you deserve. For more information, visit questrade.com now. Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. On today's show, we've got Barry Schwartz of Baskin Wealth, and he's a self-professed perma-bull. Even so, he talks pretty candidly about the mistakes he's made in the portfolio. So I love conversations that are very honest. And as always, he leaves us with his 3 best ideas. And these are stocks that are not ripping higher. They're all at an inflection point that he's putting on investors' radar. I also want to let you know, because it is the last month of the year, we've got a couple of holiday specials coming up later in the month. My show, as you know, focuses on mostly public market opportunities, but there's a lot happening in private equity and private markets. So we're going to be talking about alternative investing. Paige Ellis is going to come in and host that special. Again, that's later on this month. And then I'm happy to be partnering with Scotiabank's Women Initiative, and we've got a few extra features that are going to be coming out on Fridays. So look out for that. As always, let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof, from tax and estate planning to trust services for generational wealth and strategies for life's key milestones. Whether that's buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you'll benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $88 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. Barry Schwartz, thank you so much for joining me.
Thank you for having me again.
Yes, you're a return guest. You were with us in the early days, so we've kind of spruced up the joint a little bit.
Beautiful. I'm so proud to be part of your growth.
Oh, thank you. Well, and I guess you're a money manager, but you're also a fellow podcaster.
Yes.
The podcast is called Long-Term Investing.
Thank you.
And I like it. That's why I'm willing to plug it.
Cool. Well, it's a conversational podcast, no different than yours, but it's really just me and Ernest Wong, head of research at Baskin, talking stocks. The idea came from a client said, I wish I was in your investor meetings, right? Your portfolio manager meetings, and hearing how you guys come up with your investment ideas, what you like, what you don't like, what you're looking at. And I thought that was a great idea. Most of my clients just care how much money I make them, but a lot of clients want to know how the sausage is made. So I think podcasts are a great format for that. Doing BNN, you really just have 2 or 3 lines to talk about a stock, talk about maybe some qualitative factors. But in a podcast format, you can really do a nice deep dive on a stock or an industry. And it's a lot of fun. And I get to feature Ernest, who's a growing part of our team. And I think our clients really like the feedback. Some people say I talk too much. You should never read the comments because, oh my God, people hate me, I guess. But
no, they don't, do they? Oh my God, mine are very positive.
Yeah.
Nothing but nice things.
Some of them, mostly positive.
Yeah. Okay.
It might be Ernest's friends saying that they don't like me or something.
They want more Ernest.
Yeah, probably.
We need more Ernest. No, I totally agree with you. That's what I love about this podcast is yours is obviously featuring Baskin, but any chance to just understand how do you get to the investment? Yeah. How do you learn more about a company? Like, yes, we're all trying to buy stocks and make money. Yeah. We're also trying to understand who are the people behind it and what are they trying to create? And does the market understand that? So we're going to do a bunch of that because you're one of my favorite type of guests because you're just a stock picker and I can throw a bunch at you. Sure. But first, I do want to talk about the markets. Last trading month of the year. Yeah. We made it. Yeah. We're at December and my gosh, a lot of volatility. And November maybe was going to be a losing month. And then in the middle of the month, we just started to rip higher all because we believe rates are going to go lower in the US once again. And that's our guiding light. Talk to me about either this month or reflections on the past year and whether you're staying fully invested.
Yeah. So for me, setting the table is stocks are obviously performing well because the economy is doing well. We saw Canadian GDP way better than expected. The US GDP is strong. We're seeing interest rates starting to come down. Inflation, we may never get any numbers out of the US, but it appears that it's under control. But most importantly, Amber, it's corporate earnings, right? Double-digit earnings growth in the S&P 500 for 2025. Many expect another round of double-digit earnings in 2026. It's not hard to figure out how we're going to get there because of all the spending on AI and all the large companies that dominate the S&P 500. But the bottom line for us is Baskin Wealth Management is not having the best year for our clients. However, markets don't always do what you want them to do each and every year. I'm very happy about our portfolio. Most of our companies are reporting very strong earnings. Many of them should report double-digit earnings growth this year and next year. But the market is playing catch-up. And what I'm saying by that is if you look at all the sectors and industries and indices that are doing well this year, they're ones that really didn't do well for a very long time.
And I think that honesty is really important when you can say we're not meeting the index because the index has done incredibly well. So as you assess and reflect, why is that? I know you typically don't own or invest in gold. So, in a year where gold is doubled, that's a hard pill to swallow.
Absolutely. When you have some gold stocks up 230%. But you have to think back. Okay, let's say I did own a gold stock and I bought it in January 2024, for example. Would I still be holding it to today? Yes. So you have to ask yourself these questions, right? Is it reasonable to expect that you'd be up 26% owning the TSX? Now I'm getting calls from clients saying, you're underperforming the TSX, right? Or shouldn't we be all invested in Toronto Stock Exchange? Or you don't know what you're doing, you should own gold.
Do they say that to you?
Not necessarily, but these are
implied.
It's implied. And so what they mean by that is, they want perfection. And I'm here to tell everybody that perfection doesn't exist in investing. If I was perfect, I wouldn't be managing your money. I'd be charging you a 25% management fee if I could get it all perfect. So what we have to do is focus on the forest, right? What are your performance over a number of years? How have you performed in up markets and down markets? What are your companies doing? And to me, it's really the best of both worlds. When stocks are down, I get to buy more of things that I like. And if the earnings are growing, they're going to perform over the long term.
This is good insight into the business of managing money because you at Baskin, you have a compass of things that you like, compounders, and you're very much, you're always focused on long-term. I know that your podcast is called Long-Term Investing. But I guess when people come to you and say, I like all of that, so I want to invest with you, I guess it's important not to waver on that just because like for 1 year, that's not in style.
That's right. In any 1 year, anything can happen with the markets. And honestly, it tells you nothing about the future. It only tells you how you've done up to this year. So I feel, I'm happy for everybody who's making a ton of money this year. Why wouldn't I be? That's a good sign for the economy. And but I caution people who think that investing is easy and all you have to do is just buy gold and it goes up. That's not the way it works, right? And in 25 years of doing this, whenever something gets super, super hot with no earnings behind it, you have to be careful. I'm not saying gold does have earnings behind it right now, but it's a crowded trade for sure.
So you're still not touching that sector?
I'm not touching gold mining. I don't think it's a good business. I focus on companies that can reinvest cash flows at high rates of return, companies that have competitive advantages, companies that can control their destiny. Gold mining has generally been a lousy, terrible business. It's catching up now, like 30 years of underperformance and catch up in a year and a half. Wonderful. But and we can all see what's going on with assets and inflation. Things are crazy in terms of costs. So gold is just catching up, but that probably is a good thing for stocks going forward. If gold's going up, stocks should follow eventually there too. And
you don't swear off commodities in general because there are other companies that can't control their commodity that you do own, but we're not going to talk about it because it shows up in the mailbag. But you highlight something that I think is really important for people to understand. There's always a reason, people throw out, something I've come to understand this year is people throw out a lot of information, good information and bad information, and generally both are correct.
Okay.
Right? The GDP, for example, that you just referenced, there's a lot of problems with it. It showed that businesses were struggling and government was kind of taking over. That is factually correct. The question is, does it matter?
Yeah.
Right? And I think you also reference like earnings. I think at the end of the day, that's all that mattered this year. Not tariffs, not anything else. It was, are these companies growing profit? And they are.
I mean, that's all that matters over the long term, right? If you plot a chart of corporate S&P 500 operating earnings against the S&P 500, they pretty much move in a smooth line, right? And so that's what drives stock prices at the end of the day is earnings. So if your company's delivering good earnings, and everybody on X and on Twitter is telling you it's a bad company because they're telling you the price and they're backfilling a narrative. I don't care about that. I'll get them wrong, no question. But if the fundamentals are telling me a much better story than what the stock price is, that's an opportunity.
I know you as a real bottoms up type of investor, meaning you start with the company and then you'll layer on later, or is not as much of a priority kind of what's going on in the macro. But I would like to hit on, there's two anxieties in the market. One is rate cuts. It seems like investors are like, we're going to get one in December, so everything's fine. The other is AI. And all of these kind of circular deals and the fact that all roads lead to one company, OpenAI, which is losing money for the foreseeable future. I'd like your thoughts on that, but I'd also, even if you don't care about that macro picture, it could still affect literally everything because so much in the market is being indexed to AI now.
Well, AI is a thing. We're all using it and it's helping businesses. And as a business owner, I'm looking for ways to help our clients and our employees and my business with AI software and AI products to try and improve efficiency so my employees can work on more productive things. One of the things we're doing is just using AI for transcribing calls, for using AI for entering data. That's a lifesaver instead of someone typing things in. And so the more we use it, the more other companies are going to use it going forward, in my opinion. But the bottom line for us is it's hard to tell the future. All we know is there's keen interest. This is a real thing. There's billions and billions of money spent on it. And this circular stuff is nothing new. If you look at, I just read a book by John Malone, the creator of cable, pretty much. And John Malone, it was his biography. I mean, he did circular deals where they helped out other companies to get the new technology off the ground. How else do you get it started? One thing that's so fascinating is you have these companies with billions and billions of dollars in cash. We see today, NVIDIA just made an investment in Synopsys, right? $2 billion deal. NVIDIA has $100 billion in cash. Amazon has tons of cash. So they're all making so much money that why wouldn't they help fund their customers? It's no different than the airlines, right? When Boeing makes a plane, it's not like Air Canada has tons of money to go out and buy the plane. They get vendor financed. There's lots of ways to help your customers. And if you believe in your industry, this is what companies should be doing.
So when does it become a problem? Or does it become, I guess the obvious way is if you don't get a return.
Yes, you need a return
on those investments. And I guess you have to have conviction that you will get a return.
I assume so. So obviously OpenAI will at some point go public. So that should fill its coffers with a bunch of cash. Obviously, at some point, OpenAI will try to monetize this by charging God knows what. We're now getting into an era of agentic AI where things will help businesses and consumers, right? And so what would you pay for that, for a personal assistant? $10 a month, $20 a month? Don't know. And still only a few small percentage of the population is using AI, right? So as the tools improve, it could be a home run. We're all skeptical at the beginning. It's fair. It's right to be skeptical. And those that were skeptical on Tesla and NVIDIA and all those companies, they look silly now. But you have to sometimes invest with dreamers. You have to invest with those that are going to change the world. And I don't think we're going backwards with AI. So I'm very excited to invest in companies. And I'll talk to you about our strategy, how we do that if you want.
Yes, and we'll get into, we'll see it with some of the picks that you brought to us in the stocks. But you do care about valuations, and are you comfortable with them at these levels?
Yeah, I am comfortable with them at these levels. And I mean, it depends. I own a portfolio of stocks. I don't really care what the stock market is doing so much. We'll have conversations around our office. Well, what happens if NVIDIA loses out in chips to Google and the stock price falls 50%? Will that kill the stock market? Maybe it will hurt the stock market in the short term, but it really doesn't matter. If you're owning great businesses that sell products and services that people use every day, then we'll use them we'll use their pullbacks as an opportunity to buy more for sure.
Let's do the mailbag now. Okay. We've got so many stocks in the hopper.
All right.
The mailbag is brought to you by BMO ETFs. If you're a do-it-yourself investor looking to take control of your portfolio, BMO ETFs makes it easy. Whether you're exploring stock replacement strategies or you want to find ETFs that hold your favorite companies, their tools are built to help you invest smarter. Check out the ETF Compare tool, the Stock Replacement tool, and news and insights under the Tools section at bmoetfs.com. It's perfect for analyzing your options, spotting trends, and building a portfolio that fits your goals and timeline. Okay, our first question, actually, it's really timely because we've got all the Canadian banks reporting this week, and the group is at record highs. So the question is, would you continue to hold or trim as valuations get expensive? This one coming from Tom in Richmond, BC.
So let's talk about narratives for a second. All right. So 2023, 2024, the big narrative was the banks are going to get destroyed, right? Interest rates are up. People are going to have to renew their mortgages at high levels. Oh no, we're all dead. Guess what happens? Interest rates come down. It's not really an impact. And now Canadian banks are at record highs. So the narrative of the day is a talking point and tells you nothing about the future because the economy is so variable. Things change so quickly that you really have to focus on the companies. So we've owned National Bank in our portfolio for about 21 years. It's the best performing bank stock, and they've done an incredible job. We also own Royal Bank. We owned TD Bank. I sold it pretty much at the bottom, but that's fine because I swapped it for Royal Bank, which is still done okay. But National is our biggest. So why are the Canadian banks at all-time highs? What's going on? Because it's not a robust economy. Wealth management's doing quite well. Proprietary trading doing great. A lot of it, Amber, is just beta, right? The stock market's up. The Canadian market's at record highs.
Capital markets.
Yeah. Interest rates are coming down. The U.S. financials are doing great. A lot of Canadian financial stocks are doing quite well. Also TMX, Power Corp, Fairfax, you name it. So it's really beta. It's really rotation to maybe a safer sector, right? With all the worries about the tariffs. So the Canadian banks are still trading at reasonable valuations. if the growth is going to be there a couple of years out.
I always say that there's two ways for a high multiple to resolve.
Yeah.
The price can come down, but the earnings can also go up. And there was a downgrade of Royal and TD recently, and it really was just valuation. And so let's use Royal as an example. Do you still hold it?
We do.
That is expensive. And then there's a great debate about whether that premium is warranted, because more than any other large bank, they do really consistently deliver.
Yeah, it's the Royal and National are two of the top quality banks, and you can see it in the return on investments that these companies produce, and you can see it in the loan losses. You can see it in the linearity of the earnings. All banks screw up once in a while. Bad things happen that you can't control. The economy will go down, or you make just really bad investments, or you have some fraudulent things that happen. But Royal and National seem, over the last 15 years, seem to have the coast is clear, so to speak, for them.
It's interesting. I was talking to somebody who does a lot of work with the banks, and they said, all the banks obviously are interested in what each other are doing, and they want to know what's this bank doing and sort of best practices. But they called out that National and Royal don't ask that question. They ask, who does this best anywhere? So if it's customer service, for example, I want to know who does this best, not just out of the 5 banks, out of global companies. And they're always just trying to be the best at this one thing, not compared to the other banks, but compared to the best out there. Everybody thinks about the 5 Canadian banks as just a homogenous group.
Yes.
But shed some light into your process, because you did pick National for 15 years. You did pick Royal for 15 years and not, say, CIBC
Oh, we did pick TD, so you can beat me up.
TD,
So no, there's no perfection, but what we're looking for is a combination of strong management, following through on what you say you're going to do, not investing in risky geographies. Although we can talk about what with National Bank, it's made an investment in Cambodia that could be considered risky. Really, it comes down to the management team at National Bank. I think they're just a phenomenal team, and they've really made some smart acquisitions. I think the acquisition of Canadian Western Bank just shows like National Bank is still a growth stock. There's a growth opportunities. It's a small bank with lots of opportunities to continue to consolidate more rural areas across Canada and build out its commercial lending as well.
Now that TD has a new CEO at the helm, is that on your watch list? Would you go back in?
No, I think we're comfortable with Royal. We quite honestly haven't spent any time on TD since he got rid of it. It's kind of like, you throw it in the garbage and don't look at it again. That's a mistake, of course, in investing, right? You should always keep an open mind. But, obviously we were very turned off by the issues that the bank had.
Yeah, the anti-money laundering issues, which they're still working through. We know the penalties and stuff like that, but the bank does have to change quite a bit. Let's just talk about a risk to the sector, highlighting risks in 2026. I think, mortgage renewals get brought up a lot, but we saw that coming for years. Yeah. Do you spend a lot of time thinking about the trade risks? There's a big renegotiation that has to take place between Canada, the US, and Mexico on, call it NAFTA 2.0. Yeah. And you can easily write a headline that, all parties walk away. This is not going to be an easy negotiation. Yeah. It seems like banks would be vulnerable to that.
I don't think about that stuff. And it's the same. I remember being on your podcast. The big issue was the tariffs. And I said, don't worry about it. The bottom line for all governments, all businesses is they want to make money, right? They'll fight, they'll try and get their way, they'll bully each other. The U.S. obviously has the leverage, but they also want growth. That's why you're seeing some of those tariffs being backed out again or backing down on them. So I think everybody has the best interest in heart for their countries, for their people. And that's why I'm always a perma-bull on stocks. That's the growth. We all want to improve our lives for our families, for our kids, for ourselves, whatever country you're in. And so that's a positive tailwind for stock markets over the long term.
I love when people confess what they are, and being a perma-bull over the long term has been historically the right trade.
Absolutely. So if you look at history, right, in any calendar year, I think it's close to 80% of the time the S&P 500 has a positive year. What we're all worried about is the 20% of the time, how bad it's going to be. Or is this the time that it just keeps going down and never recovers? I don't subscribe to any of those fears. And whenever someone calls me up and says, I read in the paper that Joe Blow said this about the markets and it's going to go down and we're going to have a crash. Do what you want. I'm not going to follow that. I've read that a billion times by lots of people. So it's not helpful because no one knows what the stock market is going to do in the future. But if you believe like we do that, invest in GDP, invest in good companies, you have management that are aligned, they want to make a lot of money too. And there's some people that really understand long-term investing. Long-term investing is very, very simple, but few get it. It's the reinvestment of cash flows at high rates of return. It's not getting the dividends. It's not getting, investing in the next speculative idea. It's really a math problem, and a lot of great companies have figured that out.
I feel like that segues perfectly into our next question, which is on the telcos. Well, on Telus in particular, what are Barry's thoughts on Telus? They've owned this person, M.Nanda on Instagram, has owned it for some time as a long-term investment. And right now, there's a lot of hair on this story and concerns that Telus is the next when it comes to a vulnerable dividend. BCE, of course, already cutting their dividend this year.
So you have two of its competitors, right? BCE cut its dividend last year. Rogers stopped raising its dividend for many, many years. That tells you what's going on with the industry. You have in the US, you look at a lot of the cable guys like Charter, its stock is terrible, and other competitors. It's not a good scenario right now for the telcos. No question, we're all addicted to our phones. I'll never give up my phone and never give up my plan, but the plans are commoditized. And it's very easy to switch. And these companies have made tons and tons of investments. The regulatory outlook has not been kind to them recently. They're easy to beat up on. And the bottom line is it's another math problem. The dividend does not, the free cash flow does not cover the dividend at Telus, nor did it cover it at Bell, nor did it really cover it at Rogers. And so you have two things you can do. Either keep going until you hit a wall, or you make the decision that you cut the dividend. And so that's the problem for investors is they love their dividends. Once they get their dividends, they think it's great. But the ironic thing is once the yield gets up to that 6, 7, 8% range, that's the warning sign and that's the time to get out.
It's so funny. If I titled this video like dividend paying stocks, it would go gangbusters.
Yes.
Because people do love their dividend. And for a certain age group, like you live off of them. So it is important. Would you put Telus in kind of the yield trap category? And just generally, where is dividend payouts and things like that in kind of your ranking of importance?
So I was talking with a good friend of mine, another portfolio manager, and I said, can you name like one awesome dividend paying company that doesn't like and that doesn't exist? They're all mature businesses. I don't want to say so many negative things. I'll get attacked here, but the bottom line with dividends is you can recreate dividends yourself, right? So if we look at the pipelines, utilities, all these companies, they're highly levered, right? They have leverage of 4 times, 5 times. And so why not just buy a smaller dividend stock and use margin, and you can lever your dividend too without the worries of owning a bad business. So I'm not saying that all high dividend payers are bad businesses, but they're very leveraged and they serve a purpose, but there's no growth. Growth solves all problems for companies. Dividends don't solve any problems. They cause more problems because what's going to happen is the cycle's going to turn, competition's going to come at you, the regulatory outlook is going to change, and then you got no money to do anything else. Or you're then forced to make really crazy decisions like Bell did buying cable assets in the US, broadband assets.
You didn't like that?
I don't like that at all.
So you're not in this sector, period?
Not in the sector, period.
But you have been in the past.
We have been in the past, and we're learning as we go. All right. And so I would say that as most money managers starting out in Canada, we were very much dividend focused 10, 15, 20 years ago. We've changed our tune. We've now realized that owning companies that can reinvest at high rates of return is the way to compound our clients' return. And if our clients are looking for income, we can always either create a tax efficient income by trimming some of the stocks, capital gains are taxed at a lower rate, or we can own more fixed income. I don't want to buy dividend stocks. Are stocks. They're not bonds. They're not their own asset class. They're just as risky as owning shares in Google and Apple and Microsoft.
Let's apply this framework to CN Rail, which has been a laggard. And, you said something, growth solves all problems. We got a question from Young Guns on Instagram, who's a loyal watcher of the show, so we appreciate it.
Great movie.
Started buying CN Rail. What are your thoughts?
So we used to own CN Rail. We owned it for a number of years. We owned it through the activist pressure where the whole management was kicked out.
No, sorry. This is CN.
CN Rail, yeah.
Not CP.
CN was also under activist pressure. Yeah.
When?
Yeah. Remember the CEO stepped down?
Oh my gosh! Yes, sorry. Yeah.
So what they were saying is that they were trying to get the company to buy back stock and improve operations because it was not doing well recently. The reason we got rid of the stock is the growth never met its targets, and so the valuations on the railroad stocks, I would say 23, 24, got to some of them 20, 25 times earnings on expectation that they would deliver double-digit earnings growth. And, for whatever reason, whether it's tariffs or high rates or weather, it just never materialized. One of the issues we saw with CN Rail was it was buying back stock using debt, so leveraging its balance sheet. It could be a right thing to do, but really, I prefer companies using free cash flow to buy back stock. So trucking, railroads, it's a bad place right now.
Okay.
So if you're a long-term investor, it's never been a dumb idea to bet on the Canadian railroads.
If you're a long-term. So you would put it on your radar list.
They're fine businesses. Yeah. They should grow at GDP plus. They have some pricing power. Canada, as we know, is a gigantic country. You can't just move goods from Toronto to Halifax that easily. You need railroads, right? And so, and essentially it's a duopoly. So there's a lot of great things going. You can never build another railroad in Canada. We're still going to be moving lots of goods going forward. So I like the businesses, and the valuations are much more attractive now, but I still think I have better growth ideas.
I can't believe I totally spaced on the activist. It was in 2021. I just had my third kid. So I feel like that. Okay. I remember now that's why I missed that whole thing. Yes. And that's how Tracy Robinson came in.
Yeah, and Tracy's done a nice job at CN Rail. She wasn't a railroad person. That's an issue too for us. I already have a large investment in Berkshire Hathaway that owns a large railroad there. I've made a bet on trucking. So I think that's enough exposure for our portfolio. There's
a lot of M&A happening. You said you can't build a new railroad, but there are attempts to consolidate in this space. Are you playing in any of that? And do you think about how that could affect the Canadian railroads?
Well, I think the Canadian railroads are takeover targets. There was a time when many thought CP could be acquired. Even Bruce Flatt at Brookfield wanted to buy CP Rail. These are terrific assets. It just really is there synergies between, if they get acquired or they merge. It's hard to know.
You think CN Rail and CP Rail could be takeover?
No, anything's a takeover candidate. These are publicly traded companies with no large insider ownership.
From a regulatory perspective,
no, from a regulatory,
this would never happen.
Well, things change with governments for sure. So I don't think they're takeover candidates, but I'm just saying that we're seeing more consolidation. It makes sense. And so eventually there'll be 2 or 3 railroads out there. And eventually CN or CP may be one company or be merged with a larger U.S. entity. It makes sense to have full railroad coverage across the entire North America and into Mexico.
Okay, that was spicy takes. CN Rail, I love it. Okay, you've mentioned Buffett a few times. We actually got a question on Berkshire, which has underperformed this year. So don't feel bad, Barry. It's not just you.
It's so funny seeing underperform. It's only up 11 or 12% this year. And boy, oh boy, you're so dumb. The long term, I tell my clients 8 to 9%. The way we invest, owning great quality. I'm not a hedge fund. I'm not a long short. I manage the wealth of high net worth clients, and the most important thing is not to lose it. So I'm, when people say you're underperforming this and that and the other thing in any one year, you don't understand the strategy I'm trying to take. I'm trying to protect your money over the long term. And of course, people don't understand also that when you start investing, it's not a clean slate every single year. You can't just blow out your portfolio and buy all new stocks. And there's capital gains, there's transaction costs.
Does that mean in down years you do better?
It just depends. Some down years I will do better. Some down years I'll do worse. It's random. Random walk. Isn't that a famous saying? It's a random walk down Wall Street in the short period of time. Tells you nothing. It just tells you what people are excited about or gravitate to in the short term.
Well, these pullbacks or these periods of underperformance can also be a great opportunity if you're looking to buy. So let's talk about that with respect to Berkshire, which has started to trend up recently in the last couple of months. Is this a stock that you ever think about owning?
We do know it. We own it. We've owned it for a long period of time. We lost our brains for a minute and sold it and swapped for another stock, but we got smart and got back into it.
Which stock?
Well, actually, it worked out for us. We sold Berkshire and bought Stryker around the same price. Stryker is a healthcare company.
I know, totally different. They live in different worlds.
The reason why we bought Stryker at the time, this was 2020, I guess, during COVID.
Okay.
And so we thought, oh my God, you can't go to hospital. They're not doing any hips and knee replacements right now. They're filled with people sick from the pandemic. But eventually, you can't put that off forever. And the stock had fallen. We thought it was a great opportunity. That worked out for us.
On Berkshire, they think the vibe is that, because Buffett is retiring, this is just, the enthusiasm for the stock has waned a little bit. You've owned stocks through some important transitions when the founder leaves. And you know that it can show up in the stock price. How do you assess the risk of that transition?
We've owned Apple since 2012. So you're probably getting that, like Steve Jobs, like Apple can't innovate anymore. It will never be the company it was under Tim Cook. Like that's just words. Look at the fundamentals. Look at what the company's doing. Look at the tailwinds. Berkshire, the one thing that I'm kind of upset about is Warren Buffett should have been buying back stock in the last few months. And they didn't. And I don't understand why, because I think it was under pressure, the stock, because obviously he's announcing his retirement, 95 years old. Let's give the guy a break. Great job, Mazel Tov.
Soon.
Yeah. But the bottom line was the stock was under pressure under that. I would have thought it would have been a good signal, similar to what Constellation Software insider management did when Mark Leonard stepped down, is they started buying stock personally. I thought it would be a good signal to the markets that we have confidence. It didn't happen, but Berkshire still knocked it out of the park with a good earnings report recently.
So they're not only are they not buying stock, they're net sellers of stocks, and they've got a record cash pile. Buffett has always said he's an optimistic person. He's like you, optimistic, never bet against the American economy. But then you look at what he's doing. Where is he buying? He's buying in Japan, net seller in the US, and rising cash pile. Yeah. People like to infer that, what does that mean about future returns?
Yeah. So let's talk about the cash pile. First of all, it runs an insurance business. It must maintain a certain amount of cash.
But this is more than that.
Yeah. So when people throw out the $300 billion, it's really closer to $150 billion that it actually has as excess capital that it can use. Its insurance business is gigantic and it must protect it. Like Buffett's never going to run the cash down to zero because if anything bad happens in insurance, it's a bankrupt company. So it has about $150 billion or so net in cash. We can speculate till the cows come home as to what's going on, what they're doing. People will say he's market timing. Buffett says he's never market timed in his life. People are saying he's waiting for valuations. That may be true. Maybe he's setting the table for Greg Abel to chart his course as president, as CEO. Selling the Apple, of course, looks pretty stupid now that the stock has gone up 40, 50% since he sold it. But it was also like an insane position, right? It could have been $400 billion position in Berkshire. That's nonsense. It's too risky. So you just don't know. I guess he's getting 4 to 5% on Treasury bills, completely safe, risk-free. Why not? Why not? And until a great opportunity presents itself.
People often compare, Fairfax to Berkshire. Mm-hmm. Do you own Fairfax?
I do personally.
Okay,
and unfortunately, I didn't buy it for clients.
Would you add here? this is also, there's a book about it
Yeah,
too, which
just
you
started,
said you're
yeah,
reading The
yeah.
Fairfax Way. Just high level thoughts then, since it's not in the fund, but you do own it, do you continue to like it here?
So there are just some people that understand long-term investing. And obviously Prem gets long-term investing, right? So there's the Constellation guys, the Fairfax guys, the Berkshire guys, Murray Edwards. These are people that really understand how to grow, how to grow returns over the long term and how to use the structure of a publicly traded company in the right way, right? Sometimes issuing stock, sometimes using your stock, sometimes issuing debt. Prem comes up with lots of different strategies to take advantage. He used a total return swap to buy back his shares of his stock instead of laying out cash. It works out brilliantly. But the bottom line is he understands compounding, and I want to invest with managers and owners that get it. So whenever I hear a business that runs decentralized, that's focused on M&A, that has a founder that's still running the business, that the management owns a good stake, that they aren't paid outrageous salaries, I get interested. And I like to buy like a little bit for myself, but for the clients, I really have to focus on 30 of our best ideas. I can't be buying them 150 stocks.
Well, I know Constellation is one of those best ideas. And out of those 3 criteria that you laid out, right now they're hitting 2 of them, but the founder question has weighed on the stock. We've got a question from Fred. You like to find compounders. Constellation has been that this year, a rare year where it's down. Have you bought it? What do you think of that management transition and whether Constellation can still be a beautiful stock without Mark Leonard?
Yeah, the stock is essentially went straight up for the last 10 years. Here's your pullback. Here's your opportunity. And it's, once again, you can backfill any narrative. You can say the stock is down because of Mark Leonard. The stock is down because of AI vibes. Yes. Yeah. The stock is down because it's not investing in it. Like, whatever you want to do. But let's focus on the fundamentals, first of all. The last 2 earnings reports showed organic revenue growth. It showed that Constellation is still able to reinvest at high rates of return. The issue is it's not growing as fast as it used to in the past. And so that's the natural thing that's going to happen with large companies. Constellation almost got to $100 billion market cap, and it's big. It's a big, big company, and it's not going to grow at 30 or 40% a year anymore. So we have to get over that. But it doesn't mean that we can't make double-digit returns going forward. And now I think the stock is really priced for those to earn a great double-digit return from here. Maybe the stock arguably was overvalued at 5,300. I should have maybe trimmed a lot more. I didn't. That's fine. But I'm excited to continue to double down on the stock here over the long term.
So you've been adding?
Absolutely. So we maintain a portfolio of about 30 stocks. And we're always buying them. We're waiting, obviously, for pullbacks as new clients come in. But if we own it, we're still buying it. We don't put holds on stocks, and I don't micromanage position sizing that much. If it's working, let's continue to own it.
Okay, let's keep this going. Founder-led companies you love. You don't love gold stocks because they're exposed to the commodity that they can't control. But I know in the past you have liked, and maybe you still like, Tourmaline and Canadian Natural Resources. Still like them?
I do.
Okay. They are darlings. Everybody likes them, but they are both underperforming. Why are they underperforming?
Because this is a bull market, and in bull markets, people gravitate to the more exciting companies, right? And so the Peytos and the Tamaracks of the world are more, or the Strathconas, they're more sexy, they're more growthy. But I'll stick with the stalwarts, right? And so I tweeted the other day that CNQ has raised its dividend 25 years in a row and still has 33 years of inventory. That's total proven reserves, and unproven reserves could be as high as 40 years. I'll take my money and invest in a company with that much durability, that much ability to reinvest the cash flows at high rates of return, and a really thoughtful and diversified approach.
So the vibes have been, we like these companies that are not spending, and they're taking the cash that they get and they give it back to shareholders in dividends or buybacks. And the knocks I see on both Tourmaline and CNQ is that they're just not doing that at either the pace that they used to or at the pace of peers.
Yeah.
Does that also explain why they're kind of not as exciting as some of the other stocks?
I think it's a combination of, like I said, just beta in the market, just bull vibes. People just get more excited about companies that have faster growth opportunities. But if you're selling a company because it's investing for the long term and not giving you the cash now, that makes no sense to me as a long-term investor. And so that's my opportunity to continue to buy more of Canadian Natural Resources and Tourmaline at these levels. And then when I see the CEO like Mike Rose, I think he's already bought 230,000 shares this year. That's real money. That's $12 million, right? He's not fooling around.
And we've had him on the podcast, so I encourage you to listen to that. And I know you guys have talked about it on your podcast. You don't like gold because they're not in control of the commodity. You think they're bad businesses. Why are these energy stocks different?
Because they have economic use, right? They're used in the economy, and there's a two-letter word or an acronym that is driving lots of things, and that's called AI, right? And so we see the energy use is insane. Just demand, and if we're going to be building that many data centers going forward, they're talking about sending data centers into space. Look at how much natural gas we have here in Canada. Look how much oil we have here in Canada. Look at the safety. The country is run in a normal way. They've access. We should have more access to our oil, but I feel really comfortable about investing in oil and gas right here because of what I see as a huge demand, especially for natural gas going forward. Tourmaline has gigantic fields. It's investing hugely in its business. And Canadian Natural, like a gigantic, large natural gas producer that people forget about. A lot of it goes to use to run its oil sands production, but still a gigantic producer. We're quite bullish on the natural gas use going forward.
All right, let's find out your highest conviction ideas maybe for 2026 and get into your pro picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, before we do that, I want to revisit your past pro picks, which were on February 4th, and they were all tech stocks: Apple, Microsoft, Meta. Yeah. And Apple and Microsoft since then are up 20%. Meta's down about 7% because there's been a little bit of a freak out.
Just recently, the pullback on the recent earnings, You
still own all of them?
So Meta reported 26% revenue growth. Just think about how beautiful that is. This is a company, $1 trillion plus market valuation and growing top line at 26%. It's the ultimate proof that AI is working for it. And so you want to beat up the company because it wants to invest more in AI. Mark Zuckerberg is, just a truly original thinker. Truly, he has the ability to make things come true, kind of like Elon Musk. I want to invest in that, but I'm able to invest in that at a really great valuation versus Tesla trading at 100 times earnings. I think Meta is trading around 20 times earnings, but it's trading at a depressed earnings because they're investing so much in AI. That could slow down, then the free cash flow could start to explode again. So we're very excited to own it. And I think there's a nice opportunity given the recent pullback. And
also you picked it in February and then in April, it all tanked. And so the fact that I assume you held on, did you add more?
Of course.
Yeah, Barry Schwartz. We know you held on.
Of course we held on. Yeah.
Okay. We're going to talk about what you're buying now or what you, like in the market right now. I heard you say on the podcast that trucking and rails is a bad business right now. But long term, you're CN's on the radar, but trucking is here and now for you. Yeah. Let's talk about that through TFI International. Disastrous February results.
Okay.
Stock fall. I mean, it was a disaster in the stock. The stock fell 20% in a day, and it hasn't come back since.
No.
Enter Barry Schwartz.
Okay, so disastrous stock move, and no question the earnings have been sliced in half this year. The amazing thing is this is one of the worst freight recessions ever, yet TFI is going to earn $4 US per share this year in earnings. So it's not like it's going bankrupt. It's not like it's in financial trouble. It's going to generate $700 to $800 million US of free cash flow, and it's controlling the controllables. It's improving its operations. It's buying back stock. It raised dividends. This is crazy to me. It raised its dividend twice in 2025. The worst freight recession we've seen in a long time. A lot of it, of course, is just, the overspending that happened after the pandemic and everybody buying things with free money. By the way, I think there's going to be a lot of free money next year. So just pay attention to that. So for trucking, they're controlling the controllables. They said in the most recent quarter that the bottom is near, and they're still warning that the fourth quarter is going to be really, really bad. But this is a company that has so much torque to just a little improvement in freight pricing. And if that's the case, you're looking at a gigantic return on investment going forward.
It's interesting you bring up management comments, and I'm curious how you assess management in these bad times. Yeah. You said you're a perma-bull, but I assume you don't like to see that in management, and you want to see them say, this is bad.
Yeah.
And we know it's bad, and this is what we're doing. So that when they say, this is a bottom, it actually means something.
I think you nailed that one. And the CEO, Alain Bouchard at TFI, is very frank, very transparent. He'll tell you when things are terrible, but follow what he's doing. The company is aggressively buying back stock here. It is generating so much free cash flow in a really rough period. It's quite remarkable. And they're voting with their feet. They're buying back stock of the company instead of making acquisitions. This is a very acquisitive company, many acquisitions over the last number of years. So all we need is a little improvement in the freight. Freight is very cyclical. It can move very, very quickly. What's happening is a lot of trucking companies are going bankrupt. You see the immigration issues that are happening in the US. So a lot of truckers, if you could be deported or what have you. So things are setting up on the supply side. We just need a little improvement of demand, and the stock's going to take off.
Okay, so possibly a stock at an inflection point, and let's bring that to the second pick, which is Couche-Tard.
Yeah,
beaten up this year. 7-Eleven, will they? Won't they? Now they're not going to. Then everybody obsessed about get your mojo going in the U.S. And then they started to a little bit. Is Couche-Tard at an inflection point?
I think so. And that's really the theme of my picks, right? Is to own companies that have been kind of forgotten by the most recent rally. They're great past compounders. They've run into some issues, but the compounding will continue again. So what we were waiting for with Couche-Tard is for all their geographies to start showing same-store sales growth. Canada and Europe were doing fine, but US was really in the doghouse for a couple of years. Now it's turned a corner. A lot of it has to do with them offering much better food, like fresh food or prepared food.
And nicotine. Like Zyn.
I need one right now.
Do you? You don't. No.
No, but
clean living for
clean living for sure. But vaping and heated tobacco and the pouches have offset cigarettes. I mean, we're humans. We get addicted to something, and that's it. And so, no question, it's facing secular decline of smoking. That's a good thing. Alcohol, you saw that fewer people are drinking alcohol. These are good things for humanity. So what does Couche-Tard try to do? It has to offset it by offering better food offerings and really improving margins. And that's what's been the case the last few quarters.
Your final one then is QSR, Restaurant Brands International, a real range-bound type of stock.
Yes.
What is there to get excited about for Couche-Tard?
This is one where...
for QSR.
For QSR, for Restaurant Brands. This is one where when I own it, the clients will say, I don't see the catalyst here. Or a Burger King, gross, right? Or Tim Hortons, I never go there. Someone's going there because the same store sales growth at Tim Hortons has been phenomenal. There's no issues there. It was really the turnaround at Burger King. They hired Patrick Doyle, who was a turnaround specialist at Domino's Pizza, who had one of the best track records on the stock market, running Domino's Pizza for about 10 or 14 years. He's come in with a healthy compensation package based on stock price performance. It hasn't done anything so far. But what he's doing is following the Domino's playbook, trying to improve. This is a royalty business, and so the franchises take all the risk. But what you need to do is make franchises happy by having them, get better returns on their franchises, and that's what that's what Restaurant Brands has been doing. It's been renovating a lot of the Burger Kings. And the catalyst going forward, its leverage has come down. It just signed a nice joint venture in China where they want to expand to 4,000 restaurants in China, Burger King. International results are very strong at Burger King as well. The company is valuation is trading at a discount to the McDonald's, but with better growth. Many of the fast food companies, as we've seen, have been struggling lately. Chipotle, not McDonald's, but a few other names. Restaurant brands has knocked it out of the park over the last few quarters, even with a tough U.S. consumer.
Thank you for bringing these ideas to us and spending the hour with us. I appreciate it.
Thanks for having me. Anytime.
That's Barry Schwartz joining us from Baskin Wealth. Don't miss our next episode. You heard Barry say when he looks for income, he goes to the fixed income market. And actually, that's what our next episode is going to be about. We've got Dustin Reed of Mackenzie Investments. So all your bond questions, we don't do a lot of these shows, so you save them up for this episode. Email us questions@inthemoneypod.com, and we'll see you on the next episode.